Assalamualaikum and good day. For the introduction, I will briefly explain the background of our topic, which is currency risk management in multinational corporations. In today's global economy, multinational corporations operate across many countries and use multiple currencies in their business transactions. While this creates greater opportunities for growth, it also exposes firms to currency risk due to fluctuation in foreign exchange rates. This movement can significantly affect a company's revenue, operating costs, asset values, and overall profitability. Even small changes in exchange rates may lead to financial losses, reduced cash flows, and weaker competitiveness in international markets. Therefore, effective currency risk management is essential to ensure financial stability and support long-term international expansion. To manage these risks, firms commonly apply hedging strategies like forwards, futures, options, and natural hedging. These techniques help stabilize cash flows, reduce uncertainty, and improve confidence in financial planning. Overall, the purpose of our study is to highlight the importance of currency risk management for multinational corporations and to evaluate how different hedging techniques are applied in the real business situation.
So, let's take a look at the key concepts. The first one is why currency risk matters. It is because currency risk is a major challenge for multinational firms. Exchange rate movement affect company revenue, operating costs, competitiveness, and reported profits. Even small currency changes can impact financial performance. The next one is there are three main types of currency exposure, which is transaction, translation, and economic exposure. Transaction exposure occurs when payment or receipts are made in foreign country, and translation exposure happens when foreign earnings are converted to home currency during financial reporting. And the economic exposure is a long-term effect of currency changes on competitiveness and cash flows. So there are examples of companies and their exposure, which is the first one is Coca-Cola and IBM. They mainly face transaction and translation exposure because they operate across many currency globally. And the next one is Rolls-Royce, where they face economic exposure. So now let's move to the frameworks. The first one is financial theories behind hedging, which include interest rate parity. Interest rate parity is a basis for forward contracts, and forwards rate reflects interest rate differences between countries. The second one is government called hedging model, which is used to price currency options, and it's also considered volatility and interest rate differentials. The next one is corporate finance justification for hedging. Hedging helps reduce cash flow volatility, avoid financial distress, prevent underinvestment, and stabilize tax obligation. And the last one is macroeconomic factors that drive currency risk. Global shock increased volatility, such as Russia and Ukraine war, economic sanctions, and US interest rate hike. And all of it causes exchange rate volatility, capital fight, and investment sentiment shifts.
Good day everyone. In this session, I will discuss real-world example of how multinational corporations manage foreign exchange risk and protect their performance during currency volatility. Coca-Cola operates in over 200 countries and face high transaction and translation risk. It actively uses forward contracts, opinions, and swaps, which help stabilize income when US dollar appreciated. This shows that forward contracts are effective for predictable cash flows. Meanwhile, IBM focused more on natural hedging by matching revenues and expenses in the same currency. This reduced hedging costs but become less effective during high volatility. In contrast, Rolls-Royce suffered loss during Brexit due to under-hedging. Its revenue cost currency mismatch exposed the firm to sharp pound depreciation, highlighting the risk of insufficient hedging during major shocks. Solatec faced complex currency exposure across euros, US dollars, and Chinese yuan. Its initial natural hedging failed when the euro depreciated sharply, reducing EBITDA. The company then adopted a layered hedging strategy using future for short-term risk, forward for medium-term exposure, options during high volatility, and swaps for long-term. This case shows that flexible multi-level hedging is more effective than relying on a single tool. Indian MNC. A study of 61 Indian multinational firms shows that over 80% use currency derivative, while nearly 40% use foreign currency debt. Firms with structured hedging strategies show higher financial stability and firm value, proving that hedging is also a strategic decision, not just a short-term fix. Coca-Cola HBC. During the 2022 crisis, Coca-Cola HBC reduced rubble debt, increased local cash reserve, and used forward and currency swaps. It also applied hybrid hedging using commodity futures, showing how firms must expand risk management during geopolitical shocks. In conclusion, these cases show that there is no single hedging strategy for all firms. Effective foreign exchange risk management requires flexibility, proper timing, and a combination of tools to protect profitability and long-term firm value.
The slide shows the impact of hedging on companies. So the first point is hedging helps companies protect their cash flow and earnings when currency rate change. Because of this, companies like Coca-Cola and IBM were still able to remain stable even when the US dollar became stronger. Next, hedging helps reduce risk and increase company value. It makes future cash flows more predictable. In the solar tech case, effective hedging helps improve cash flow and net present value. Hedging also helps companies perform better. By using tools such as futures, forwards, and options, companies can reduce costs and increase their overall value. However, if companies do not hedge properly, they can face serious losses, such as Rolls-Royce is an example, where poor hedging during Brexit caused financial problems. Large changes in exchange rates can also affect the whole economy. So overall, this shows that hedging is important for managing risk and protecting company value.
From the comparison, it is clear that the effectiveness of hedging strategies depends on how well an MNC integrates both financial and also natural hedging, especially during currency instabilities. Companies such as Coca-Cola and Solartech use a multi-layered approach combining forwards, options, swaps, and operational adjustment, which provides a stronger protection against currency volatility. But in contrast, Rolls-Royce rely on limited hedging tools, increasing its vulnerability and showing that narrow hedging strategies are insufficient for firms with high structural exposure. Across all four articles, Coca-Cola, IBM, Solartech, and Coca-Cola HBC rely heavily on forward contracts as the foundation of their hedging strategies. Articles 1 and 2 highlight forwards for short-term exposure, while the Indian MNC study shows that forward-like derivatives and foreign currency debt support a longer-term structural exposure. However, there is no single instrument is sufficient during extreme volatility or geopolitical events. For example, we can see that Solartech case shows that forwards alone could not protect the firm during the euro depreciation, while the Coca-Cola HBC still faced translation losses during the Russian-Ukraine war. In my opinion, the most effective hedging strategy is a layered combination where forward form the core and it is supported by the options during volatility and swaps for long-term mismatch. This approach balances certainty and flexibility, leading to a stronger financial resilience. Therefore, forward contracts are the strongest primary hedge, but the most effective overall strategy is a multi-layered system tailored to the firm's risk profile.
In these sections, I will discuss the recommendations and overall conclusion. Multinational firms should adopt flexible and diversified hedging strategies to manage currency risk. Using a combination of hedging tools such as dynamic currency factor hedging can allow firms to adjust to exchange rate changes, reduce earning volatility, control costs, and stabilize cash flow during uncertain periods. Next, from an investor perspective, currency risk management is an important factor in international investment decisions. Investors should prioritize firms with diversified hedging strategies, strong corporate governance, and transparent foreign exchange disclosure, as these firms are more attractive for long-term investment. Policymakers also plays a key role by promoting transparency in foreign exchange exposures and maintaining clear regulatory guidelines and consistent monetary policies to reduce exchange rate volatility and support financial stability. Next, moving on to the overall conclusion, this analysis highlights that currency risk is a major financial challenge for multinational corporations. Exchange rate fluctuations can significantly affect revenue, costs, and competitiveness. The cases show that firms with a diversified hedging strategies are better able to stabilize earnings during volatile periods.